Hello, everybody. My name's Drew Demon, and I'm the Devil's Stockbroker. This is the Demons meeting for December the 18th. Merry Christmas, everybody. Let's take a look at what the market has in store for us. First, we got the overview of the market. The weekly is what I find more telling. Tesla got absolutely beat up, down 13% on the week. It's definitely the worst performing stock in the S&P right now. There's a lot of finance sector stuff that's getting hit, especially in the insurance industry. We've got Progressive. Pretty sure I saw Aflac in here as well, getting beat up, and most of the banks, including Wells Fargo, JPM, and Bank of America, are collectively down about 2% each of them. Financial services for credit cards as well are not doing too good either. You can see those down here in the commercial services sector. Visa's kind of break even. MasterCard, pretty much the same. But PayPal and SPGI are all doing very poorly, which is uncharacteristic of how the market's been behaving as of the last 3 months or so. Most of these stocks have been holding up despite everything that's been going on. I think that it's pointing to speculation that the consumer debt has grown to unhealthy levels. So that's kind of more like a macroeconomic sign of things to come. As for like what's worth trading in the short term, electronic technology and tech services are the sectors I think to short, along with energy, minerals, and oil producers. Utilities companies they're okay. Um, Retail sector is kind of a mixed bag. So let's go ahead and jump over to the S&P really quickly. For the SPY, we had a really interesting setup. I think that we pretty much perfectly timed the top here with this last play. We had the double top formation with this first candlestick that just barely tapped on the upper resistance of that megaphone pattern, and then we broke through on the gap up with CPI print. We had a much cooler CPI print, and I guess that was enough to give people a whole lot of hope and banks a huge opportunity to liquidate a bunch of positions for at least not too terrible of a loss. So they took their opportunity, and this is definitely one of the biggest red candles we've seen in the market for a while. We dropped pretty harshly. Then we ended the week all the way down here, down at 381.04. The market is not having a great time, and we're definitely now squarely in bearish territory for the next few months. I think that we're going to expect to see another cycle of selling. This one might be even more aggressive than the last one. So last time when we had our big sell cycle, we saw the worst of it in the first half of August and September, or the second half of August, first half of September. That was when we saw the biggest 1-day drops or 1-week drops back to back. And then we had broken this bottom, and this is where things started to get really weak. It's right here at this bottom. This time, I'm expecting us to break it because we did not recapture the highs in August. Not that I thought that we were going to, but for the bull case to play out, it would have had to. They would have needed to see the market recover back up above this level and hold up here above 420. And I said it many times that that's just not realistic. So now that we're back down here at around 380, we've got a few things in front of us that we can try to analyze to give ourselves an idea where we're going to end up by the end of next week. So before Christmas, I'm kind of expecting a bit of sideways trading, not a whole lot of movement in the market. I could be wrong, but we had the dividend from the S&P on Friday. So after Monday, Tuesday, if we don't get a big turnaround, then I'm going to expect the market to trade sideways. But for Monday, Tuesday, I'm kind of expecting the market to try to make a pump to hit this 200 period moving average on the hourly chart. So retest 390, somewhere there in that area. That would be the bull case, but I still believe that it will reject off of that level and will continue further downward once we form out a bear flag. The other possibility that I see is that because of this dividend, we just end up selling straight down into the rest of the week. So far, we do have some pretty aggressive sell volume. Volume direction candles are getting rejected now off of the slow moving average. So if there's not a big turnaround on Monday and Tuesday, then I think the momentum continues to the downside for a while. The only thing that it really has going for it is the MACD is crossed on the 1 hour, and we have the RSI trying to hammer out a bottom, but we're still in a downtrend on the RSI. So it has not created any higher lows yet. So no signs of strength just yet. All we really have is the fact that the MACD is turning around, and all that tells us is that the sell volume is slowing a little bit, not that it's turning around at any time soon. So, yeah, like I said, if we don't see that big turnaround for Monday, then things don't look good. Let me go over each of the mega caps, starting with Apple. This one took the worst of the beating, actually. It broke this diamond pattern that had been forming over the course of 3 months now. It broke it to the downside. We're now sitting at a level of support that Apple has not tested since June. This is the lowest point that it's been at in 6 months. And before that, you go out to the daily, Apple hasn't traded in this area since June of 2021. And that was during its big run during the summer rally of 2021. That only lasted for about 35 days. That's not a whole lot of trading volume or a lot of time for support to be formed. You can see that we've got most of the support sitting right here at 135. So this is where I expect Apple to bounce one more time and create a weak bounce. Reasons why I'm thinking that is because we had a very weak bounce here and then a rally that occurred in November, right around CPI day. And that was part of one of the cooler CPI prints that saw the market rally, and Apple's big print is part of what drove that rally. Now that we've tested this area and we're back here again, I'm expecting a weaker rally and then for it to fail to break previous resistance and capture it as support. But I do expect Apple to come back from this bottom pretty quickly. We need to wait for some signs of strength. But we can see that there's at least one possible sign, and that is with this higher low on the RSI right here, as well as higher lows on the MACD. So very subtle signs that Apple might bottom here for the week and come back, probably ending the Christmas week somewhere around 140 at the highs. I doubt it breaks this. It's hit this level twice, and there's so much volume traded in this area with heavy sell volume. I don't think that Apple is going to recover back to 150 again this year. For Amazon, this one's kind of tough for me to call because we have higher lows right here for one. We have higher lows on the RSI, MACD, and that's very bullish. We do have the Christmas rally to think about, and it does tend to be the case that Amazon and most of the retailers do very well during the Christmas season. So I am considering a long position for Amazon going into Monday and Tuesday, but I don't want to stay in the position for the long term. So if I'm going to take any scalps, it's probably going to target Amazon to the long side because I think that will be the one that can move the quickest. You can get some weekly contracts for calls or something like that and capture a move between $85, $87 up to possibly 94, but I would probably stay pretty conservative and keep your takes somewhere around $90, $92, somewhere in that range. And that's only if you're doing like day trades or weekly swings. It's not something that I would stay in for the long term. Google is doing much better than I thought. It's holding up really well compared to its peers, but it's definitely still in a downtrend. I haven't looked at Google in a long time, so this is probably overdue. But like we have this perfect parallel channel, and I think that we might see Google trading back down at approximately $70 within the next 2 months. So Google can be a good short for for a monthly swing. It's getting some bullish divergence right here, so we might see it pop back up and touch this resistance one more time, and that would actually put it right up at the top of its channel as well. So if we get that, get another rejection here, then this would be the ideal entry somewhere in this area. I could actually leave some orders sitting right here and just try to capture Google at these levels. So if Google turns around next week and taps like 100, 100 might be the best that it can do because that's a pretty big psychological number. I think it would be really tough for it to recapture this level. But if it could get to 100 by January, then that would be an excellent entry for a short position. And you could take this to either the low from November or wait a while. Like you could buy a short position if you're willing to wait. That's a lot of margin though, just fair warning. And take it all the way back down to like maybe like $76. Probably be waiting until March or maybe even April for that to actually play out. So it's a long time to wait. Google will take quite a lot of time to work its way down. Johnson & Johnson is still performing. It's outperforming almost everything in the market. One thing that makes me nervous is that it's now closed 2 candles outside of this channel to the downside. So it might retest this 200 period moving average right here. Let me look at the daily. Yeah, it's pretty spread out from its other moving averages on the EMA. But you can see that we got a golden cross here of the 50 and the 200 EMA. So this is a good sign for Johnson & Johnson, and the defensive plays, like especially healthcare, have been doing really, really well. They're probably the safest stocks to just keep your money held in. It works as a really nice hedge. You can see that Johnson & Johnson hasn't really ranged too wildly over the last 2 years. The one thing that does make me nervous about it is that you're right here in the middle of this big head and shoulders pattern at the top of its chart. That's the one thing that makes me really nervous about Johnson & Johnson is this big head and shoulders. It's been forming this for a while. So if this thing comes down, like it might be coming down hard. And we could revisit pre-pandemic lows. Somewhere like here or here would be a more conservative target. So be very careful of Johnson & Johnson. It is defensive, technically speaking, but it just like everything else during the pandemic, it got overbought like crazy and pushed to all these new highs. Thank you guys so much for tuning in to watch this video. If you enjoyed the content and you found this information helpful to you in your own trading strategies, be sure to leave a like on the video. It helps out the YouTube algorithm and helps us reach out to others who need this information too. Be sure to subscribe if you want to see more. And if you're not a member of Hell's Trading Floor already, consider joining our Discord by joining us at hellstradingfloor.com, which will allow you to sign up for our Discord at discord.gg/hellstradingfloor. Thank you guys so much for watching, and I look forward to seeing you in the next one. Until then, have a hell of a time in the markets.